Welcome to Chapter 10. In the previous 2 or 3 chapters, we've talked about budgets and the flexible budgets, and then comparing performance. In Chapter 10, we're going to shift gears, and we're going to look at what items are relevant for us to be using as we make our decisions. In Chapter 10, we're going to look at short-term decisions. In Chapter 11, we're going to look at long-term decisions. So if we look at the steps of decision-making, notice again, we're going to define our task. What's our goal? What are we trying to accomplish? The second is we're going to look at alternative actions, because remember, you always have at least 2 choices. And we tend to forget about that when we're managers, because we look at this and we say, well, I can do nothing, or I can buy this new machine, and we think of it in terms of having just one choice to buy this new machine. But in reality, doing nothing is a decision. It's an alternative course of action that we take. Our third step then is we're going to collect all the relevant cost information, all the quantitative information, and analyze it. Then we get to step 4, and we're going to select our course of action, and it's here at step 4 that we would apply the qualitative factors before we make the decision. And then finally, in step 5, we analyze and look at our decisions. So let's move to slide 8, and let's look at what is relevant. The key item on this slide is the very last item, and I can't emphasize this enough. In order for a cost to be relevant to a particular decision, it must meet 2 criteria. The first is that it must be a future cost. The second is that it must differ between the alternatives. So what does that mean? By definition, that means all sunk costs are not relevant, or as we like to say, they are irrelevant, because they are past, they are historical, they are sunk costs. Again, to repeat, for a cost to be relevant, it must be A, a future cost, and B, it must be different between the 2 or more alternative courses of action that you are examining. So if we move to slide 9, 10, and 11, we'll go through those fairly quickly. Slide 9 we already talked about. Those are sunk costs. They're historical, so they do not meet the criteria. Therefore, they are not considered in these types of decisions. In slide 10, we look at out-of-pocket costs. These definitely are included because they are a future outlay of cash, and it will be different depending on the different courses of action that we take. And then in slide 11, we look at the opportunity cost. And with the opportunity cost, again, it's the example we used very early on in Chapter 1, I believe, where we talked about if we were going to spend $20,000 on a new machine, we have passed up the opportunity to use that $20,000 for some other use, and therefore there is a cost associated with that. Now, we're going to look at 6 different decisions that managers make in the short term, and we're going to cover those fairly briefly. And again, you can refer to the text and the other PowerPoints to get you more detailed information. First is, do we take additional business? Do we accept that special order? We're running a business. we manufacture an item. We get a special request from somebody that wants to do an employee giveaway or a customer giveaway, and they ask us, would we make for them 1,000 of our units? And we have to decide then, should we accept that order or not? And here, since we already have our base business, our decision concentrates itself on our incremental revenues that we will get from the new order, and we will compare those to the incremental costs. By definition, what this means is we ignore fixed costs, and we only look at what additional revenue do we get versus what additional cost did we expend, and quantitatively then that tells us we could get by with not charging. We could sell this product for a lower price because the fixed costs have already been covered. That's the quantitative. The qualitative part of it is we run the risk that if we do a special order and our longtime customers find out about it, that we sold to somebody else, a new customer, at a lower price than we sold to a longtime customer. We run a qualitative risk of a dissatisfied longtime customer. These are the types of decisions that management needs to make. But before we even get to the qualitative, we have to know quantitatively if this order makes sense. Okay, so that's the first one. Then we move to slide 22, and we're going to talk about a make or buy. And this is what I call the outsourcing decision. Certainly outsourcing is all over the news. Another way of saying outsourcing is, should we make it internally or should we buy it on the outside? And again, our decision quantitatively is analyzed on the basis of our incremental costs of buying it on the outside, of outsourcing it, compared to our costs on the inside. Again, our variable costs, because our fixed costs won't change as we look at our outsourcing availabilities, unless we can sell the plant and get rid of the plant. And that brings in a whole different set then of alternatives. But I think you're getting the idea that what we're looking at are those costs and revenues that will change between each of our choices that we make. So then if we move to slide 26, we now come up with our third special decision, and that is, should we scrap an item? In other words, we had a defective product that we manufactured. Should we just throw it away, get rid of it, or should we try to rework it? And here again, what we want to look at is, can our rework costs be less than the original cost plus the rework cost? Can those be less than our selling price? And if so, then we want to rework, as long as we can put out a comparable quality product. So that's our third. Our fourth decision that we make is the sell or process further. And here what we look at is, I like to look at I use this example a lot, of the donut shop. Everybody's been to a donut shop. Everybody's had a donut, even in these days of everybody being health conscious. We all break down occasionally and have a donut. Well, when we walk into the donut shop, we have our choice of buying the simple cake donut. Now let's look at it from the donut shop owner, from his or her point of view. Every morning at 3 in the morning, when they start baking all of today's donuts, they have a choice of making a cake donut that they sell for a certain price, or they can put all the additional toppings, fruit-filled, cream-filled, chocolate glaze, the sprinkles, all of the different things that go on it. And the question then becomes, should he sell or should she sell that cake donut, or should she process it, or should he process it further? The answer to that question is the additional revenue, is the price difference between the cake donut and the fully loaded donut, is that additional revenue, does it offset the additional costs to make that fully loaded donut? So that's our fourth type. If we move to slide 35, we get to our sales mix. And here we have to understand that what happens when we make two products, we can no longer just compare the profitability of product A to the profitability of product B. As long as they both take the same amount of time to make, then we can do that. But if product A takes twice as long to make as product B, we need to factor this into our capacity at our plant to determine should we make more of A or more of B, and which is the optimum mix for those products. So that's our fifth special decision. And then finally, one that a lot of companies are facing today in today's environment of cutting costs, and that is, should we close down a product line or not? Should we get rid of a poorly performing product or a poorly performing division? And there again, what we want to concentrate on is revenue that we lose by getting rid of that division. We want to compare that to only those expenses that we can get rid of by closing down the segment or the product. In other words, if we can't save more costs than we get rid of in revenue, then it's not worth making the change. So, and a lot of times we look at a division and we say it's unprofitable, we need to shut it down. We fail to take into account that a lot of those costs we can't get rid of because we have a plant that we can't sell, we have insurance, we have depreciation, we have costs of plant security. So it's not as easy a decision as looking at the bottom line and saying that's unprofitable, get rid of it. So there we've kind of looked at then the 6 decisions that we make in the short term. Now we get to what I've talked about since the first chapter, the qualitative factors in our decisions. We need to look at product quality, especially if we outsource. We need to look at delivery schedules. Can our supplier meet our delivery requirements that we had internally? We need to look at the reputation of the supplier, our employee morale. If we outsource everything, we're going to end up with a very disloyal employee base. And finally, our customer opinion. So we do all the quantitative analysis that we've described throughout the course. We do that first. We follow it up with the qualitative factors, and what we may end up determining is that the qualitative factors may offset or outweigh a quantitative decision that we otherwise would have made.